Welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in financial markets for this week and beyond. Today is Tuesday, May 20th, and joining us today are Mike Larson, Doug Davenport, Larry McMillan, and Mandeep Rai. Okay, well, let's get started with the call. I figured a good topic for today. I know we've touched on this in the past, but the old market saying that it's time to sell in May and go away is certainly seems to be apropos so far. This month we've seen a lot of volatility, especially last week with the early week strength leading to a reversal later on in the week. So let's talk about that a little bit. Of course, the official statistics on selling in May are really dismal. I mean, going back to 1928, the May to October period has always been the weakest 6 months of the year for stocks. The average return is only 2% compared to 5% from November to April, the strongest 6 months. And those returns are actually amplified during a midterm election year, which of course 2014 is, perhaps because of election negative campaigning jitters or whatnot. The weakest 6 month period during the midterm year actually shows an average decline of over 2% at this time of the year. So with the volatility that we've seen so far, I guess a good topic is what are you doing in your services? Is it time to sell or at least trim back and be a little bit more cautious? Mike Larson, why don't we go ahead and get started with you?
Yeah, good morning. I tend not to be a huge fan of calendar-based indicators, just in general. I mean, I'd rather look at what's going on with the current market environment and where the economic environment is going and so on. When it comes to what I'm looking to do. So I think I monitor that, but I've never made a trade just based purely on the calendar. What I think is more noteworthy to me is that we've continued to see interest rates sort of defy conventional wisdom and move sideways slightly lower here, even as the overall market has been generally climbing higher, at least when you look at the major indices like the Dow and the S&P. You've had weakness in the NASDAQ, you've had weakness in the Russell, and some of those other indices. But overall, stock markets have continued to hold up and make marginal new highs, despite the interest rate pressure. So I think that it's kind of a conundrum out there. Either stocks are going to catch down to what interest rates are doing, or interest rates are going to catch up to what stocks are doing. Is kind of how I look at it. I mean, I don't see how you can have both markets right about the general state of the economy, the direction of inflation, and so on. Either stocks have it right that the economy is going to reaccelerate now that you're out of that winter period. Things are going to pick up, and that's going to be bad for bonds and good for stocks. Or the bond market's going to be right. There's more trouble brewing. Something out there is going on that we're not seeing fully yet, and therefore the weakness in interest rates is foretelling weakness in the broader economy, and therefore weakness in the S&P and the corporate earnings outlook. So I think that riddle kind of has to be solved at some point soon. Or that's more than anything else is going to lead to a rough summer and fall for equities, more so than just the calendar. I think it's just something has to be solved when it comes to that riddle. So while interest rates are just being stagnant in this environment, I've been doing more indirect interest rate plays. Some positions like Franklin Resources or HSBC that are more active in the emerging markets, which had gotten hit hard, but I think a lot of the bad news has been priced into those markets. So continuing to look for a little bit of rally there. Whereas I think at the same time, some of the tech levered type stuff like the Ameritrades and E-Trades of the world, they're kind of within the rate sensitive sector of the market. They're trading very heavy, and they're not really benefiting from what's been going on in the broader market. So that's kind of where I'm looking for a short side exposure. So I think it's sort of a mixed book environment, long some stuff, short a little bit. For the first time in a long time, I mean, I really wasn't short anything for a long period of time because the markets overall were trending up. But now you're seeing some pressure within subsectors of the interest rate and rate sensitive part of the market. So that's what I'm monitoring. One last thing I'd point out is everybody's fallen in love with the utilities and because of their higher yields, their bond equivalents and so on. So with bond prices generally going higher, the utilities have done well. But what's interesting to note is in the last couple of weeks, the utilities average has started to weaken, carving out a little head and shoulders top here potentially on the daily chart. Utilities had an ugly day yesterday. The XLU, for example, cracked its 50-day moving average on pretty decent volume. So, that could potentially be a harbinger of some more weakness in the bond equivalent names for the short term. It may be that they just finally got too extended, based purely on the interest rate trade alone. So I'd be watching utilities, see what happens there, as well as the REITs, which have held up a little bit better than the utilities, whether or not they follow, whether or not bonds roll over as well. That's kind of the thing that I'd be watching there. And lastly, I still think the euro currency's got more problems. That's one of the shorting the euro, I think, is one of those really strong trades. It's going to work out for months, not just a few weeks. Had a very key reversal in the euro currency 7 or 8 days ago when Draghi basically said enough is enough and threw in the towel on euro appreciation. And he's not alone. The entire political establishment, financial establishment over there wants a weaker euro, and I think they're going to get it. So if we can crack this sort of 136.5, 137 level on euro, I think we got about another 4 cents down there, 133 give or take, in this move, and then potentially as low as 131. So that's one of those other trades that I have on and that I think ultimately works out.
You touched on interest rates earlier, and certainly we've seen bonds do pretty well this year, as you pointed out. I think the global aggregate bond index is up over 4% this year, while the the S&P 500 and the Dow are barely up 1%. Small caps are actually down. What do you make of the move in upside move in bonds and the decline in the 10-year Treasury to 2.5% interest recently?
Yeah, I think a combination of things. U.S. economic data for the first quarter being weak. I think there's a China obsession with the bond market. Basically, as long as you have a daily headline talking about another real estate crash in China or weakness in China, that's been driving the bond market. So even though the U.S. economic data has been fairly firm, and certainly other developed markets like the UK have shown pretty strong growth, you've had a lid on interest rates out of fears of China. It's a big economy. And that's been part of it. And there's some other weird stuff going on. I mean, one of the kind of esoteric things that's out there is the Treasury International Capital Department, tucked away in the Treasury Department, tracks who's buying around the world, buying treasuries and other instruments. And of all places, Belgium has shown a 300 billion or something increase in Treasury purchases, which is like half the size of Belgian GDP in the last 4 or 5 months. Even as official holdings of China and Japan have stagnated. So there's some talk that maybe, there's buying of treasuries being routed by China or some other big purchaser through the European monetary system, and that's where this buying's coming from. Again, kind of conspiracy theories. But the reality is, I think it boils down to, the bond market somewhat skeptical the economy is going to accelerate later in the year. And in that situation, bonds can hold their value. So we'll have to see. Obviously, like I said, I was incredibly right about the bond market last year and the year before. I've been wrong the first 5 months of this year. We'll see what pans out.
All right. Thanks for those comments. Doug Davenport, let's go to you. What do you make of these crazy markets?
Thank you, and good morning. Well, I look at the markets through the charts, and the market's basically telling me that growth is slowing. Because you look at the Russell 2000, it's down 9% since March and down 5% year to date. And you look at the yield spread of the 10 and 2 year, and that's compressing. That's about 48 basis points year to date. So when you have the yield spread compressing, you've got financials being squeezed, and that's why you've got XLF down, negative return year to date. And GDP numbers, as we all know, have been horrible, and I think that the GDP will probably, those numbers will probably be much lower even this summer, just because of growth slowing. And bonds have obviously, as you all just talked about, have been the best performing asset class worldwide even, and TLT is up 11.75% this year. And this is the first time this year that we've had a net long position in futures and options in long bonds. First time. Versus a short of 81,000 contracts 6 months ago. So the consensus has been completely wrong on bond yields and growth for the first 5 months of the year. Fortunately, my charts had me in TLT since January, so I'm happy with that. You look at the S&P 500, net short contracts there, about 40,000. That tells me people are putting on hedges. You had a net long position of over 16,000 just 6 months ago, so now we're short versus long, whether that really matters a lot, but it does show people putting on hedges. And I guess the big question is what's causing this slow growth that has pumped up yields worldwide and in the United States. And to me, it's inflation that's accelerating, because you look at the CPI, PPI, and that number's been up it's been at or above 2% only twice in the last 2 years, and we're there right now. You look at cattle, they're up 13.5% year to date, so food is up. So if we're going to throw some meat on the grill this weekend, it's going to cost you more to go to Publix and get that steak. And cattle prices are at an all-time high, and all-time is a long time. You look at wheat up 8%, corn up 8%. So you've got inflation accelerating. You've got REITs are up over 14% year to date. You know, what's interesting is 1/3 of the people in the United States rent, and rents are skyrocketing. And a good example of that is my son, 29-year-old guy, lives in Buckhead, the most desirable place to live in Atlanta, and rents are higher there, but he signed a contract on a condominium a year ago. He paying $1,500 a month. Well, he has a 2-year contract, but new units just like his are going for $2,100 today. So that's almost $600 in 1 year for, well, it's a very desirable place, but rents are going up. Janet Yellen needs to understand that over 40% of the Americans' budgets are basically food and rent, and inflation is going up, even though she says it's not. Now, the consensus says that we probably still may have 3 to 4% growth this year, and bonds will be at 3.3% on a 10-year yield. I don't know if that's going to do that. The market's not telling me that for the last 5 months. It's not telling me that now, but those things obviously can change. And if you want to get specific about the S&P 500 and NASDAQ, well, the focus has been on the S&P. The trading range has been within a very narrow box, as I've talked about before, for the last 2.5 months. So, but if you look at the chart, we've got 2 unfilled gaps at about 1896 and 1890 on the S&P 500. And those remain as unfilled targets because gaps tend to be filled, and probabilities are that that will be filled this week, I think. But volume is terrible. If you look at the volume yesterday compared to 1 month ago, it's 21% below what it was a month ago, and it's down 41% in volume from what the average was just 3 months ago. So volume is not much out there right now. I think the more important chart, though, is NASDAQ, because it's very important to see if the trend line from November 2012 is going to continue to hold, and there's a current flag being formed right now, which could be the right shoulder of this head and shoulder pattern that formed since last October, November. And that's on the daily chart. And either we're going to do this, we're either going to break out of that neckline and break down, which would be around 39.95 on the neckline, or we're going to move to retest the prior high, which is around 43.50 on the NASDAQ. So whatever happens, a resolution of this flag or this right shoulder is obviously being watched very closely, I think, by institutional and hedge funds to determine the major impact and direction that we should see for the market going through this summer. So right now you don't want to be shark bait. There's nothing really to do except wait and see what the significant or sustained move will be away from this trading range we're in. We're either going to be up or down, and that'll tell it for the market. And for anybody who likes to look at a chart, go look at any of the major indices and look at the Bollinger Bands. Just pull that up on your chart and look how compressed the Bollinger Bands are right now for the Dow, the S&P, any of those large indices. And when they get compressed like that, they're coiling, and that means a large move is coming, and we've got to break out of this range some point in time. We just don't know when, so you just have to be careful right now and wait and see which way this directional wind will move us in the market. So,
Doug, you in your inflation survival strategy, you mentioned inflation before, and in that particular strategy, you've had some pretty good sector allocations in the iShares Basic Materials and the Energy Select Sector Spider. You still bullish on those 2 sectors here, or what happens if you get a negative resolution in the market, I'm wondering?
Well, I'm more bullish on the material sector than I am the XLE, even though the XLE has outperformed Basic Materials for the last couple of months. But unfortunately, energy is always one of the last sectors to do well before a market really pulls back. And energy has pulled back a little bit more than Basic Materials in the last week. So I think they'll do well. Well, it's hard to say. You just don't know how. If the market goes to the upside, then I'll still be long those 2 positions, and I've been long those positions for several months. But if the market pulls back, it probably would take a lot of things down with it also, and that would probably be energy, even though that's more of a defensive play. But it'll just have to be looked at on a day-to-day basis. But I've still been happy with the performance that they both had, and they both have been really outperforming most of the other sectors of the S&P in the last 4 months.
Okay, thanks for your comments. Let's see, Larry McMillan, are you on the call this morning?
Mike, I'm here.
Hey, Larry, how are you?
Good.
Good. I know you've written recently at the Money Show in Las Vegas. You were talking about the frustrating divergence in a couple of your key indicators, the put-call ratio indicators. Maybe you can tell us what you think about that.
Okay. There's a couple of ways to calculate put-call ratios. One is just to use the volume of puts and the volume of calls. The other is to what we call the weighted put-call ratio, where we look at the dollars being spent on puts versus the dollars being spent on calls. So it adds the price of the option into the equation. And those two things are a divergence right now. If you just look at volume, the situation is bearish. But if you bring in the dollar cost of the options, the situation is bullish. I really think what's going on there is that people are buying cheap out of the money puts as protection, so that's increasing the volume, in puts. On the other hand, speculators or even people looking for stock substitutes, sometimes the institutions will sell out stock and replace it with in-the-money calls, even REITs calls, just to lower the cost of the position. I mean, these days the cost of money is not very high, but still it does save you a little bit in that regard. And so that situation is bullish. So, I mean, to me, that's just a situation waiting to be resolved. I have looked at back in history where the same situation has occurred. We have weighted put-call ratios going back about 25 years. And it's only really occurred twice. Once was in 2003, and the other was in 2010. And in both times, the situation was resolved on the upside. That once the two indicators got an agreement, they were in agreement on buy signals, and the market went up for like 2.5, 3 months. So, two previous cases is hardly statistically significant, but that's the way those two previous ones did play out. I wanted to comment on the other thing that you mentioned, too. You mentioned the sell in May and go away thing. I don't know if you saw there was another study that was put out recently that if the S&P 500 makes a new high in May, a new all-time high, not just a yearly high, but a new all-time high in May, that pretty much negates the sell in May and go away philosophy. So I was just doing some research on it, but it's either happened 19 or 20 times since 1950. There's a little debate over 1 year there. But the market has been from the end of May to the end of December, so that 6-month period, has gone up 17 of those 19 or 20 times, which however you want to count it. So that pretty much is a different look at the sell and go away situation. I was even looking at it in terms of what you had mentioned, the midterm elections, and there was one real clunker in 1990. But the other times that it's happened in a midterm election hasn't really seemed to affected it. So the market has gone up from that point of view too. I mean, I don't know. I think my overall volatility is very low, as you know, so we follow the volatility indices. And last week, the short-term volatility index, VXST, actually got below 11, and VIX itself touched below 12. And that set up that long heavy day of selling that we had last week. But then it seemed to, mitigate itself, and so we're just seeing volatility at these very low levels. As noted, the Bollinger Bands are tightening. All that stuff is reflective of the same sort of philosophy. So in that regard, you have to see, volatility is a little bit overbought, but plenty of people have gone broke trying to buy volatility at low levels, waiting for it to expand. I mean, we've had these cases like in 2006 and 2005 where it just stayed low for a long time. The market went up. So volatility being low is not necessarily a sell signal. Volatility starting to increase, I think, would be a problem. So if VIX starts to pick up, starts to go into an uptrend, if it gets above, like, say, 14.5, then I might get concerned. Right now, VIX is about 12.5, and it hasn't really reached 14.5 in a few weeks now. So again, just sort of a level we're looking at there. But yeah, overall, I mean, my gut feeling is that we're in this trading range, and you're just guessing inside this range. But if it breaks out above 1900 or down below 1860 on the S&P, then I think you can follow that move for a while, because it should have some sustainability.
Okay, well, we'll certainly watch those key levels very closely on both the VIX and the S&P. Thanks for the insights. Very interesting. Let's see, Mandeep, let's go to you and your stocks under 10 service. You've certainly got some nice gains going. 3 stocks that are up over 40%, including Alcoa. Who would have thought Alcoa would be up over 40% in just the last 6 months? Great job there.
Yeah, thanks, Mike. Yeah, so that's just we look for value growth at a reasonable price. If you can find it in a market like we see today, there doesn't seem to be much reasonable pricing valuation arguments out there, but there are some. We saw PE expansion in 2013 lead the overall markets higher, and now we're sort of like at a point where things aren't as cheap as they were. So trying to find those value plays is a little bit harder now, and you have an earnings season here now where your expectations are lower. You have companies beating those expectations. We get rallies some of these stocks, but the fundamentals are we ever going to get that top line growth? And from what we're seeing so far, the spread between the earnings growth percentages and the sales growth numbers are coming in a little bit. So that's encouraging, but we want to see why that's coming in. Our earnings lower now, but it's not the case. We had a 5% growth in earnings, and we had a 2 3/4 growth in sales for the first quarter. Not too great. Not too great for the lofty valuation that we have in the markets. We're trading at 17.5 times trailing 12 months, 16 times forward earnings. We need to see better corporate earnings to validate that kind of a multiple in the markets. But that being said, we also look at free cash flow yields, and those are, although they're slightly below historical averages, they're pretty much in line at 6 3/4% versus 7% average going back multiple quarters. So we're not saying that we're at a overvalued situation here. What we are trying to look for is what is going to be the catalyst to take this stock market higher, because you're at all-time highs now. Investor sentiment is neutral, a little bit jittery. You had some big money managers saying, don't be too long at this point. We're looking for a 20% correction in some of these growth names. And like Mike was saying, a lot of that has been played out. I mean, we've had FireEye go from $90 down to the mid-20s. We've had Twitter totally go, miss their earnings expectations and the user numbers. They, Amazon, the list goes on and on. We've seen it. So we think that this could, what we've seen in the last couple of days in terms of the NASDAQ and the Russell coming back, we're still in the range. It hasn't confirmed that we're breaking to the upside yet, but there could be potential. And the catalyst that we think is going to be CapEx. From the earnings calls, we've seen that sentiment has been increasing a little bit in terms of management indicating that they are going to be spending more money as growth comes back in the real economy. The corporate sentiment rises, and that increases the intention to spend more in future quarters. And if you look at expectations for the third and fourth quarter, they're higher than they were for the first 2 quarters of this year. So that could be positive. You spend more money on growth, you create multiple revenue streams, you increase your R&D. Hopefully, if management's making the right decisions, that will lead to top-line growth. And because companies are leaner than they've ever been, that increases profitability, earnings goes up, earnings multiple goes down, and then stock market goes up in relation. That's the ideal case. We'll see if that plays out. But, like everybody else has already said, it seems to confirm what we're seeing. The American Association of Individual Investors have said their numbers are showing that people are confused, and it's causing folks to buy, put protection, move to cash, what have you. You're not getting people moving into the bearish camp. You're just getting the bulls and the bears moving to neutral. Neutral's at like 45% or so, compared to historical averages around the mid to low 30s. So we're trying to wait for a breakout. We see if the S&P breaks out. That may help us, to go beyond 1900. And if we get these catalysts in growth, that could be good for the second half of the year. Right now, we're still staying cautious. We legged into a trade. To try and play out the volatility, to avoid getting one price and overpaying. We put in buy limit orders. That worked out favorably for us, but that's basically where we're at.
Okay, sounds good. We'll certainly look to see if that acceleration in corporate profitability happens this year or not. Well, that wraps things up here for this week's Squawk Call. Some great insights, gentlemen. Thank you very much, and be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.